Welcome, everyone. Thank you for joining us. Without further ado, it is my pleasure to introduce Jay Mintzmeyer, a renowned maritime shipping analyst who directs the Value Investors Edge research platform on Seeking Alpha. He's a frequent speaker of industry conferences. He's regularly quoted in trade journals and hosts a popular podcast featuring shipping industry executives. Mr. Mintzmeyer also hosts regular virtual investor forums, which are a must attend for anyone who's interested in the shipping and infrastructure industries. And to our live viewers, please type any questions that you may have for Mr. Mintzmeyer in the chat box. Time permitting, we will get to those at the end of his presentation. And with that said, Jay, I'll be right here if you need anything, and the floor is all yours.
All right, fantastic. Well, thank you for the introduction, and it's great to be back here with the Money Show. I've been on there about once every quarter or so, and it's great to come back and update on the latest in the markets. It's only been about 7 weeks or so since my last virtual webinar, and these videos eventually are hosted on YouTube as well. So I'll breeze through some of the highlights because a lot of it's similar to 7 weeks ago. I'll focus on what's different today. And we'll try to leave at least 5 minutes, ideally closer to 10 at the end for Q&A. So for those who are not familiar with our research, we are a deep value research shop focused on the shipping sector. You can follow me on Twitter for free at Mintzmeyer. We have exclusive research and model portfolios, which are, we have live trading and the models are updated monthly. You can sign up for those at mintzmeyer.com. Also, for more retail-oriented or folks with smaller portfolios, we have an entry-level newsletter, which is a lot more accessible. We'll post every 2 weeks or so, and we have a list of picks in the shipping sector, and that's www.vilite, kind of like MillerLite.com. So with that said, we'll get right into it. I usually start off with a previous performance review of the last few money shows. And if you go on YouTube, you can see the previous ones going back all the way to 2020. And you can see those picks and how they performed to date. Just highlighting the last 2 recent ones, because otherwise I'll have like 15 to go through. But last September, when folks were really bearish on the market, I came on Money Show and said you could massively outperform with maritime shipping. The average return of those 4 picks was about 17% in 4 months. And that was when the S&P 500 was roughly flat. So 16% outperformance. And the reason why I say 4 months is because 4 months later, back on Money Show saying maritime shipping is set to outperform in 2023. That was just 7 weeks ago. And the average return of those 3 picks was almost 26% in less than 2 months. And of course, the S&P 500 again was almost flat. Now, if you just watch the Money Show presentations and my YouTube videos that come out afterwards, and you cumulatively track that versus the S&P 500, since August 2020, so about 2.6 years, that would have been 370% outperformance of the S&P. So that's pretty bewildering statistics. No promise that will continue. And of course, but I'll try to do my best, and we'll share 3 picks here with you today. So today's focus, similar to the previous presentations, I'll spend about 5 minutes talking big picture, what our shop is, what we do, talk about the big picture markets, and then we'll talk about 3 sectors of shipping: tankers, container ships, and dry bulk. And then we'll try to leave at least 5 minutes, ideally closer to 10 for Q&A. So our research shop focuses exclusively on shipping. We believe this is a sector where we can outperform because there's not a lot of institutional coverage. A lot of these market caps are 500 million, maybe 1 or 2 billion. So there's not a lot of big names, big research shops in this area. Our team stays completely in our lane. We don't do anything except for shipping and energy infrastructure. So that thesis has been correct so far, and it has led to significant outperformance over the last 8 years. The first 3 years, 16, 17, 18, we had tracked trades. And then starting in 2019, we launched a model portfolio. Those are long only stocks, no options, no leverage, anything like that. And you can see the long-term track record here. And of course, 45% annualized return, hopefully that sticks out compared to the market being up only about 10% and the shipping industry being up about 9%. So it's not just a matter of which industry we picked, it's a matter of outperforming heavily inside that industry. And in case those numbers don't sound quite as good annualized, the cumulative performance really sticks out. And this is just theoretical, hypothetical, right? Some people might have done better or a little bit less, but you can see just the massive difference in total returns since 2016. So with that said, I want to pivot and talk about the shipping market and overall macro here. So for those who have followed in previous presentations, not a lot has changed here. We had 2021, which was a year of recovery across the entire segment. And then we had 2022, which was lots of disruptions. Right? We had the Russian invasion of Ukraine. We had heavy congestion in containers and surging inflation, central banks shifting their policies, lots of things going on there. Well, over the last couple of years, a lot of these companies have been drowning in free cash flow and they've completely revamped their balance sheets. There's been a lot of improvements in corporate governance, in shareholder returns, and that's led to an outsized performance. The shipping stocks on average, that's just the sector average, we did even better, outperformed the S&P 500 by 40% in 2021, by 75% last year, and we're outperforming, the sector overall is outperforming by about 10 to 15% year to date. Now, today, I want to say selective shipping equity valuations are still very attractive. That word selective is new. In the past, I would just say shipping. But we've gotten to a point where certain shipping stocks, I would believe, are fully valued or maybe aren't as attractive as they are in the past. I think this is much more of a stock picker's market going forward, as some of the names might have gotten carried away a little bit. And some of the names are still wildly disconnected. And in my opinion, they're undervalued. So as we stand today, and we're recording on March 7th, 2023, in case someone's listening to recording or something like that later, I believe the risk reward in selective names is very, very attractive. But I do caution against sort of an industry-wide basket. I think the valuations have gotten a little bit higher than we're used to over the last couple of years. So the macro tailwinds are continuing, and these are very similar to what I shared about 2 months ago, so I won't belabor them. But really, number one is the surging cash flows and shareholder returns. We're poised to see record levels of dividends and repurchases throughout this year. We're also seeing lots of regulations, which will be slowing the fleet. There's an ongoing 5-year rolling regulation, which will slow down the global fleet between 2023 and 2027. Afterwards, there's some proposed regulations that could kick in around 2030, which could even further reduce the available ship capacity. Finally, China's reopening, and we're expecting heavy stimulus across the segments. They've played defense over the last couple of years, and now they're finally getting back to opening the economy and really starting to grow things. The headwinds and risk factors, they're very similar to how they were in January. Number one is the slowing global economy, a potential recession in Europe. Europe's looking a little bit better than it was last fall, but not much. The United States labor economy is still strong, but there's concerns about the central banks and how much they're going to tighten down. And that leads to our next risk factor, which is inflation hurting consumer buying power. And that's primarily a risk factor for container ships, but it also plays into tankers. You think about gasoline and jet fuel and crude oil and all those different things, that does require a stable to growing economy. And if the central banks overcorrect because of inflation, then of course that could be a broad macro risk factor. And then finally, the disruption from war has been, I got to choose my words carefully, but it has been favorable for the shipping sector, right? Because shipping thrives on dislocations and disruptions. But any sort of World War III scenario is very bearish. Anytime trade is outright destroyed, that of course would be bad. So the status quo in Ukraine is beneficial to shipping, but any sort of heavy escalation, something involving NATO or anything involving like China, Taiwan, that of course would be bearish. And those are the big three sort of systemic risk factors that we're watching out for. So with the broad macro covered, I want to pivot to a little bit of time, a few minutes each, for tankers, container ships, and dry bulk. These are pretty similar setups to what we had a couple months ago. So again, not a lot to belabor. If you're looking for a little bit more color afterwards, feel free to look up my YouTube videos and you can see some prior webinars we've done. Now, for tankers, I want to say poised for super cycle returns. And I say poised because they're getting ready and it's not guaranteed yet. But this is the first time in a presentation I've used the word super cycle on tankers. I'm really careful with using a word like that. But crude tankers have an excellent setup, and product tankers are similar. First of all, they're benefiting from the sanctions that have been imposed on Russia, both for crude oil and also for products. But secondly, the fleet is the oldest it has been in modern history. And we have lots of regulations oncoming, rolling out through 2027. And those regulations are going to force the existing fleet to go slower and slower, which will synthetically reduce the available fleet supply in the water. Now, the beautiful part, and I have some charts that illustrate this, is that after March, so after this month, in just 3, 4, 5 weeks, there are extremely few new tanker deliveries scheduled throughout 2025 and beyond. This is the smallest, fewest delivery cycle that we've seen in tankers in the last 30 years. And that's monumental, right? Because we have all this ton mile growth because of the sanctions that are rerouting. At the same time, we have regulations which are going to slow down the existing fleet. And by the way, we don't have any new capacity coming online, or very little capacity. So that's where I believe we have the potential for a super cycle, which could run through 2026 or beyond. And I say 2026 because if everybody went out and got really bullish and excited today and started ordering new tankers, 2026 is about the time all those tankers would hit the water. So for 23, 24, 25, the coast is clear if we have a strong market. And then 26 is where, we can start to worry about future supply. So my top pick in tankers, and I'm long all these positions. I'm talking my book. I have active positions. I want that disclosure to be very clear. But my top pick in tankers is Scorpio Tankers, STNG. Of course, I have a long position there. And there's several other tanker names which have exposure through both the crude and the product sides of the market. So this first chart, it's similar to what I've shown in the past. It's actually from a presentation almost a year ago. Kudos to Euronav for being forward thinking on this. But after the invasion of Ukraine, it was clear that Russian crude oil exports were going to be rerouted. Europe was no longer going to be buying the Russian exports, both seaborne and some of their pipelines. And that means that Russia here has to export their Baltic supplies and Black Sea supplies all the way over to India or China. So we're talking about distances of 2 to 3 times. Also, since Europe is no longer importing this Russian crude, they have to source it either from OPEC countries in the Middle East, or they have to source it from Brazil or the US Gulf Coast, things like that. And so ton miles, which is volume times distance, is going to grow significantly, even if the overall consumption of oil does not change. And that's a mistake I see a lot with generalists in the market. They always think about global crude consumption or demand when they're thinking about tankers. But with tankers, you have to focus really deep and really granularly on those trade flows. So that's the crude side. With the product side, and these product sanctions just started on February 5th, and there's a 55-day grace period to offload your cargoes. So the full effect does not actually begin until April. So with these product sanctions, Russia is no longer able to sell their diesel to the European Union countries and some other countries who have supported the sanctions. Instead, they have to ship them a lot further. So instead of just going to neighboring ports, as you can see here, they have to reroute them all the way to China or to Africa or to South America. Meanwhile, Europe has to supplant that diesel from somewhere else. So are they going to get it from the United States? Are they going to get it from OPEC countries? China has a lot of growing refinery capacity. So as you can see, the distance here, the difference between the solid blue and the new lines is 2 to 3 times the amount of ton miles for the same trades. So the overall consumption does not have to grow at all, and yet we can see surging shipping demand. One research shop estimates it's going to grow by 12% this year, just based on rerouting alone. So this is one particular type of vessel. It's a VLCC, very large crude carrier, carries 2 million barrels of oil. These are the deliveries, both expected and also future order book. And you can see throughout the year, this goes back 2 decades, all the way to 2005. You can see every year there's always about anywhere from 20 to 60, 70 deliveries of new ships every year. And just to hold the supply constant, just to replace the aging fleet and keep everything steady, you need about 30 deliveries every single year. And we're in 2023, and already 10 have been delivered, and only 16 are left this year. And most of them are arriving pretty soon in the next few weeks. After that, you have 1 ship in 2024 and 1 single ship in 2025. Now, if you wanted to go out and order a VLCC, a very large crude carrier today, at the absolute fastest, maybe at the very end of 2025, but I'm skeptical that could even happen. So you're looking at 2026 before you can order one of these ships. This is absolutely unprecedented. Never in modern history have we seen the forward order book this small. It's 2% of the entire market, and all of it is done. I mean, you cannot get any ships in this category. And there's Suezmaxes and Aframaxes and other types of vessels, and they have similar SKUs. I think the VLCC one is the most extreme, but this really illustrates just 2% order book. At the same period in time, the global fleet is getting older and older. Once a ship's about 15 years old, it can no longer service the main routes. You're not going to be working with an Exxon or a Chevron or a Vitol or a Trafigura. You're going to have to do some sketchier trades, whether it's in Asia or parts of Africa. Once your ship is over 20 years old, you're basically stuck doing like dark fleet trades, stuff with like Iran or North Korea or Venezuela or maybe Russia now. And so these kind of purple, brown ships here are completely obsolete. And these red ships are kind of secondary, second tier. So the main global trading fleet is this yellow block. And so you have all this stuff on the other side, on the left tail, about 25, 30% of the market, which is basically obsolete. And you have no new supply coming on. Oh, and by the way, all the regulations are starting between 23 and 2027, which is going to slow this entire fleet down. I mean, it is incredible. I've never seen a supply setup like this, certainly in my career and arguably in all of modern history. Now, I mentioned the crude tanker deliveries are weighted towards January, February, and March of this year. That's what this chart illustrates. 68, basically 69% of the total deliveries for crude tankers are scheduled in Q1, so within the next few weeks, and then it rapidly tapers off. And then after about Q3, there's nothing for the next 3 years. And nothing, there's a few ships, but essentially, statistically, almost nothing. Product tankers are similar, about 50% in Q1, and then it tapers off again going down. So a very, very bullish supply side setup. So hopefully I've beaten the horse enough on that one. I'm, of course, talking my book. I have lots of tanker positions, but it's a very, very nice supply setup. It has never been better. So the next sector I want to talk about is container ships. And these are misunderstood cash flow machines. And folks who've seen my previous presentations have heard all these points before. But basically, I like the long-term contract structures. I like the owners who have put their ships on 3, 4, 5-year charters, and they're going to continue to earn record cash flows, even though the boom and the kind of the super cycle of containers has already stopped. And these contracts are as important as the strength of the counterparties. So we're talking about the liner companies. How strong are they, right? And over the last year alone, those companies earned more in 2021 and 2022 than they earned in the previous 20 years before that. They earned more in 2 years than they had earned in 20 years prior. So these counterparties have never been stronger. Balance sheets are very, very strong. Cash balances are huge. So there's very little counterparty risk. And so I like selective firms that have long-term contract exposure. And my top pick currently is Danaos Corp, DAC. Now it trades at about 45% of the valuation of just their contract backlog and fleet demolition value alone. So just earning the free cash flow from their contracts they've already signed, that stock could be basically double. So very, very exciting valuation setup. And there's a few other firms I've mentioned in the past. Now with containers, the mainstream macro narrative is extremely bearish. And in fact, I had one person on Twitter say, hey, Jay, I agree with you that shipping's interesting, except for those containers. They're doomed. They're going to have a terrible year. Well, if you're talking about the liner companies, you're probably correct. I mean, it's going to be a difficult 2023. But if you're looking at the ship owners who have leased their vessels to these liner companies, their 2023 is probably going to be the strongest year in history. It's probably going to be stronger than 2022, way stronger than 2021. And if you're looking at free cash flows, which is after paying back debt, after paying interest rate payments, even 2024 might be even stronger. In fact, one of the companies we follow actually has growing free cash flows for the next 3 years, even though the boom rates have already passed. And that's because the nature of the company, they're signing these long-term contracts. I expect a lot of dividend raises or repurchases across the sector, and we've already seen that in several of these firms. So the freight rates, this is what the liner companies are. This is the cost to ship something from, say, China to the United States or to Europe or whatnot. Those have came down significantly. The super cycle ended. It was about 2-year super cycle. It ended in the middle of 2022, and the rates precipitously fell thereafter. So people looking at this are saying, well, the market's in trouble, but they're kind of missing the bigger picture. Rates are starting to firm. They're starting to form a floor here, and they're firming higher than all the rates we've seen prior to COVID. And of course, this was a downturn in the market, so this is not really a normalized level. But my point is that they're firming above what was that previous floor, and I think that's pretty good, considering all the negative news flow we've had. Lease rates have also came kind of round trip, but they're also starting to firm up well above the previous levels. And these rates, keep in mind, these rates are signed for 3, 4, 5 years. So the free cash flows from these companies are delayed or lagging and will flow. If you signed a lease here, that cash flow is going to take you all the way to like 2026. So very exciting time coming forward for a lot of these lesser firms. We call them lessors because they own the ship and they lease them to the liners. So the owners are in great shape here. Finally, I want to talk dry bulk and focus a little bit on the China reopening and some of the seasonality we've talked about in the past. China's had a really rough go of it the last couple of years with COVID and their perpetual lockdowns and such, but they finally shifted away from that and they're finally reopening. They've committed recently, just last weekend, to a 5% GDP target, which, strangely enough, on Monday, the market took that kind of negatively. I think it's good to set a realistic target. In fact, I think even 4.5% growth would be fantastic for such a large economy. And that's totally different than what we've seen in the last couple of years where the economy just totally stagnated. So we're going to see near-term and medium-term growth. I expect housing and infrastructure to pick up in China. I also expect longer-term impacts from climate change initiatives, more solar power plants, more battery plants, things like that. That's going to lead to surging demand in iron, copper, cement. We're also seeing bauxite trades increase. And furthermore, when I talk about seasonality, the spot rates are rapidly improving. So that's kind of the near term, so spot rates, and then longer term are those dynamics I mentioned. So my top pick in dry bulk, it's the same one we picked 7 weeks ago. It hasn't changed. It's Safe Bulkers, SB. And they traded a significant discount to a lot of their peers. And at the start, earlier in this presentation, I mentioned how selective shipping names are important. And Safe Bulkers is a point in hand because they traded a significant discount to a lot of their peers. There's some dry bulk firms out there that I think have gotten a little bit ahead of themselves. So you got to be selective in this industry. And then some other names are listed below. And I'm long all three of those picks I've shared, of course. So last time I was here 7 weeks ago, I mentioned, hey guys, this is a seasonal market. Every year between March and April, you see a seasonal ramp. And we were down here, the 946 range last time. And I said, hey, in about somewhere between March and April, we're going to see a significant ramp up. That's what I expect to see. The question is how far and how aggressive we see that ramp. And here we are, just as expected. The next month was difficult in February, and then mid-February, the ramp has started and it's ongoing. In fact, the BDI, this is from yesterday, the BDI is even higher today. And that's not because, I have a genius or a crystal ball or anything like that. It's just seasonality. It happens every single year. So we're expecting the spot rates to improve through April or May. And then it's how much follow-on is there? How is the Chinese economic data looking? How are the trade flows panning out? And so right now, things are looking exactly like we had expected. So a quick review of these top picks, and then I want to pivot to some Q&A because I think we have about 10 minutes left. So for tankers, poised for those super cycle returns, my favorite there is Scorpio Tankers, ST and G. They have the most modern product tanker fleet. So that's diesel, gasoline, jet fuel, trades like that. Containerships, Danaos Corp, DAC, trades at a significant discount to its locked-in free cash flows. And then dry bulk, I like Safe Bulkers, stock symbol SB, because they trade at a significant discount to peers, despite being positioned very nicely in the mid-sized dry bulk segments. Again, I'm long all three of those. I have active positions. Those positions may change. Standard disclaimers, I'm definitely talking my own book. With that, I want to pivot and turn to some open Q&A. Hopefully there's some great questions in there. If anyone's interested in learning more about our model portfolios and our research approach, head over to mincemeyer.com. And if you're interested in a more affordable entry-level newsletter, a VIE Lite with a dash there.com, and you can check out our regular newsletter.
Wow, very good, Jay. Thank you. We have a lot of questions that came in. Let's start off with, are these regulations coming into effect for tankers affecting ship orders? Are new tankers already meeting these regulations, hence able to move at current speeds?
Yeah, that's a great question. So these regulations are focused, it's called the Carbon Intensity Index is one of them, the CII. Another one is the EEXI, which is the existing ship index, and the EEDI, which is the design index. So by nature of the design index, all the new builds will meet those criteria. So it's a specific level of emissions and engine efficiency that's required for new ships. So the EEDI is covered by the new builds. The EEXI, the existing ships, is targeted towards the older ones, the ones that are 15 years old, 10 years old, and so on. And that will require those ships, the ones that cannot meet the compliance, they will have to slow down. It's called engine speed limitation. So think about a car driving down the highway. If you're going about maybe 60 miles an hour, you have very efficient miles per gallon, right? But if you speed up from 65 to say 75, you're only going 10 miles an hour faster, but your miles per gallon start to plummet. Right? Well, a vessel is even more extreme. It's like an exponential curve of fuel consumption. So a vessel can slow down maybe 1 knot, 2 nautical miles, and their fuel consumption might go down 25, 30%. The last one is the carbon intensity index, which is related to that. It's how much carbon are you emitting based on your vessel speeds. So this is primarily going to slow down the existing fleet. The new build fleet should already be in compliance. However, part of that compliance is based on a very efficient vessel design, which these vessels are being designed to operate a little bit slower because it's all physics, laws of physics. So by going a little bit slower and having a little bit more efficiently geared engine, slicker paint, things like that, the vessels can meet those regulations.
Okay, we have a couple questions on the GLOP. Can you provide an update on the acquisition of GLOP and the outlook for them over the next quarter?
Yeah, so Gaslog Partners, there's what I would term a take under attempt going on from the management company. They offered $7.70 per unit. I was on record saying I believe that was far too low. I believe the fair valuation was at least 10, if not higher. I still have a long position in there. I have pared that down a little bit because keep in mind the shares have went from, they were like 5 when I got them. They went up to 6. And I think recently they were as high as like 920 or 930. I am still long. I still believe the fair value is over 10, but the hands of that are really in the conflicts committee. Is it a take under? It's kind of it's a takeover, but we call it a take under because the valuations are so low. The protection for the minority shareholders really lies with the conflict committee at the GLOP. So they'll have to hire somebody from a third party, like a bank, someone like Clarkson's or Stifel or whatever, and they'll issue like a fairness opinion. They'll say, yes, this deal is fair, or no, it's not fair, and then they'll come back with a counteroffer. So I'm expecting we'll get a counteroffer here in the next few weeks, but nothing is guaranteed. I don't really have any new information. It would all be speculation at this point.
Okay, what is the lookout container ship lessors like GSL and DAC this year?
You say, what is the outlook?
Yes.
Yeah, so in terms of earnings per share and free cash flows, 2023 should be the strongest year in history for both of those companies. Both of them have already reported their Q4, so that's Q4 of last year, and those were very, very strong quarters. We should get the Q1 results in May, and I expect those also to be very, very strong. In terms of earnings, it should be either record or basically tied for records. In terms of free cash flow, so after paying down debt, after paying the interest rates, I expect 2023 will be an all-time record for both companies, and 2024 should be similar, if not also stronger.
Right. Where do you see ZIM going over the next 12 months?
So Zim Integrated, it's a liner company. Well, they're reporting earnings next Monday. So that's going to be a very exciting day for a lot of us. The Zim short interest is enormous right now. And Zim's an interesting company because I don't have the chart pulled up right in front of me, but they were trading around $22 a share, 22 to 23, and then they went down to 21s because yesterday was really volatile. So they're in like that 21, 22, 23 range, and yet they have about $40 in cash. So what the market is saying is, Zim's operations over the next couple of years are worth negative $17 per share. So that's a really bearish outlook by the market. I think the market's too bearish on the outlook. I think a fair valuation is much closer to the amount of cash they have, so much closer to the $40 range. As far as the next 12 months, it's going to be bumpy. It's going to be volatile. I don't know exactly, is it going to go straight up? Is it going to go up and down? Is it going to be a roller coaster? I'm not sure. But I believe the market is way, way too low on Zim right now. And I think there's a lot of shorts that were smart. They got in there last summer when rates were peaking out and they had a decent thesis, right? But they haven't taken their profits. They haven't moved on. And that's weird to me. So I think once Zim comes out with earnings and once they come out with guidance and get more clarity, my hope is that the shorts will take their profits, they will close out of their positions, and we'll see Zim normalize to a valuation that makes more sense, which I believe right now at this point. Of course, I haven't seen the earnings yet. I haven't seen the guidance yet. But at this point, I think that would be much closer to 40. And I'm long Zim, of course. I need to disclose that.
Okay. What are your thoughts on EGLE after the recent earnings report?
Lots of timely questions. Look, no position in Eagle Bulk whatsoever. Just keep in mind what I said about selective dry bulk names. And Safe Bulkers was a pick 7 weeks ago. It is a pick today. It is a selective pick in dry bulk. Lots of dry bulk firms have gotten ahead of themselves. And I think last Friday with EGLE, I think that was kind of the market realizing, hey, some of these names have gotten a little bit ahead of themselves.
How about Diana Shipping stock? Is that still strong in spite of their problems?
Oh, wow. We're going through every dry bulk name. Look, I'll just say selective dry bulk names and SB. I no comment on DSX.
How do you value the risk of liners renegotiating charter rates?
Yeah, I hear that all the time, usually by folks that are citing, weird anecdotes from like tankers or bulkers in the past. Those contracts are some of the strongest legal contracts basically in the world. The only way out of those contracts is through a heavy financial renegotiation or a bankruptcy. So in the past, and when I say past, I mean, 2009, 2010, 2012, years of heavy downturn in the sector, we have seen renegotiations. we've seen bankruptcies, we've seen financial restructurings. And along with those financial restructurings, if a company is going to go bankrupt, often in part of the court restructuring or the out of court restructuring, some of those contracts will be revised lower, or they'll be sort of like a blend and extend. They'll take a 5-year contract at 50,000 and make it into a 9-year at 30,000, or they'll do something like that. That's in dire financial distress. There is no precedent anywhere for a company with strong financials, strong cash balance, strong balance sheet, either not honoring or getting out of or changing their contracts. It just does not exist. It's never happened. And so based on that precedent and based on the legal structure of these contracts, I don't expect anything to happen in the next couple of years in terms of forceful renegotiations. Now, if the liner companies have a really terrible 23, 24, 25, we get to like 2025 and the balance sheets are bad, then yes, it's like any contract in the world. A contract is only as good as the strength of your counterparty. So at this point, no, I don't believe that's a valid risk. I don't think a lot of people that say that have really studied the history of liners. But as a caveat, it does depend on the strength of the financial counterparty.
Okay, well, that does conclude the time for this session, and we have several questions that we didn't get to, and I apologize to our audience for that, but thank you all for joining us, and thank you, Jay, for your wonderful presentation.
Absolutely. Thank you, everybody.